folks. Welcome to the hedging webinar. This is specifically designed for today's marketplace. We'll get into a little bit of details of why hedging is so important right now. We've been preaching this for a little while, but as you guys well know, the last 60 days have really presented a need for hedging, particularly if you have other investments that are in the stock market, if you have investments, 401ks, IRAs, those types of things. I will have you guys notice this webinar is being put on by Wealth IQ Group. This is a company. Wealth IQ Group, I mean, this is the fancy thing. Wealth IQ Group gives you direct access to a curated network of elite wealth building and asset protection strategies vetted by industry leading experts. Holy AI. Okay. Let me take a step back and explain what Wealth IQ Group is. We grabbed a group of the absolute best and brightest people that we could find in the industry, people that knew what they were talking about, knew what they were doing, that were willing to come in and help people build and protect their wealth. We've got a wide variety of different experts. We've got experts from, and some of these companies you may recognize, some of them you may not. We've got law firms, we've got accounting firms, we've got investment advisors, we've got a gold company, we've got newsletters, we've got multiple trading organizations. The whole idea behind this is that we went out to find the best and the brightest. And what we wanted to deliver to you guys is, instead of saying, okay, many of you are familiar with, say, Pat's methodology or Bubba's methodology, instead of just delivering one singular method, we wanted to give you a comprehensive look at how to build and protect your wealth. So just as a step back, this is what Wealth IQ's real mindset is. And if you're curious, if you want to learn more, it's wealthiqgroup.com. It's continuing to develop, so you'll see more and more on that page. But we talked about strategic wealth building, which many of you are familiar with. This is trading. This is automated strategies. Talk about precious metals. A lot of you have participated in our Gold IQ Group webinars. It talks about real estate investment and development. This is brand new, guys. I'm super excited to bring this to you. Many of you who know me know I started in real estate. I started working in a REIT. And so my background is actually more in real estate than it is on the trading side. So this is super exciting for me. We talk about asset protection, liability shielding. You don't see people talking about that. One of my favorite webinars is going to be coming up soon is how to litigation proof yourself. Nobody in the industry is talking about those things. And then last but not least, of course, tax optimization for investors. This is just awesome. If you're making enough that if you're making money enough that you've got to worry about tax optimization, it's a great problem to have, but you want to know about it because it can save you a tremendous amount of money. So this is the concept behind Wealth IQ Group. This is what we're delivering to you guys. I urge you, please keep your eyes out for the Wealth IQ Group webinars, for different things that are being put on by Wealth IQ Group. Yes, the underlying companies are for profit. Wealth IQ Group is designed for education, guys. That's literally what it's designed for. It's to educate the people that are part of our organizations. So without going much further, the disclaimer, okay? This is for education purposes only. You guys, you see this every time you come to one of our webinars. I can't stress it enough, okay? Trading and investing in any capacity in the financial markets carries a high level of risk, and it's not suitable for everybody. Don't trade with money you can't afford to lose. We're here to teach you how to protect it, but you understand there's still risk. Okay. For the full disclaimer, guys, check out any of our websites. You know the parent companies, and that includes now, by the way, Wealth IQ Group. So it's me, Mike Z. I'm 25 years in the financial industry. I'm a former investment banker for one of the largest institutions in the world. I'm also the founder, owner, and operator of multiple trading education and software companies. And I like to say I'm not only the president, I'm also a client, not just of Hair Club for Men, but I like what we do. I participate in everything that we do. If we come out with a new software, I participate with it. If we come out with new education platforms, I participate with it. And by the way, that includes Wealth IQ Group. The entire real estate aspect of that is things that I participate in myself. The tax optimization, I brought those people there because I participate in that. So we don't do anything on this side of the business that I don't participate in. I'm a firm believer in that. And I hope that says something to you guys. I hope that shows you that we really do, we eat our own dog food, as they say. Great Just real quick, guys, we've won a couple of awards. This was actually an award from 2023. We also won this in 2025. We and the top prop, we're one of the candidates this year for the top prop award again. We're 5-star rated. You check us out online, check out our ratings, and guys, read the reviews, see what we do, and understand the power of what we do. So let's get to the point. What we're here for today. Okay, we're going to talk about basically four really key things, right? The first is why hedging is so important. Two is the best hedging tools. Three is how to use those tools. Okay, the how to is the important part. That's what I think everybody wants to see. And then what's the best way for you? And we'll do a Q&A after all that. So why is hedging so important? We talk about hedging a lot and you hear the word get thrown around, but understanding why it's so important, why it's so important right now, I think a lot of people just assume, oh, because, I want to protect my assets, but why is it so important right now? Let's take a quick look at the markets and how volatile things are right now. Okay, so the VIX is something, I don't know how many of you guys are traders and follow the VIX, but it's the CBOE's volatility index. It's nicknamed the VIX, okay? It's basically an expectation of 30 days of volatility for the S&P, okay? My favorite term for this is the fear gauge, right? So you got your gauges in your car, you see where you're redlining and where you're not. The VIX is considered a fear gauge. So when the VIX is high, it indicates that investor sentiment and there's a tremendous amount of risk in the marketplace and people are fearful of the marketplace. Okay. A high VIX means high volatility or fear. A low VIX means complacency and people are calm. All right. Does anybody want to guess where the VIX is right now? Okay. It's up almost 20% from last year. Okay. This is just in the last, if you're looking at this chart, this is just in the last 60 to 90 days. It's just climbing higher and higher and higher since the beginning of the year. Okay. This is actually a scary thing when you see the VIX climbing like that, because that impact on the market, that's an indicator to the rest of us, not just of the volatility, but also market sentiment, that people are getting nervous, people are getting scared, people are getting concerned about the volatility in the market. Okay. Anybody who's watching the S&P right now has seen this. Okay, I don't have to show you guys the price volatility, because if you're participating in any capacity, you've seen some huge drops. This isn't even the intraday. This is over, what is this, a 60-day period. Okay, this isn't even the intraday, which has been insane, right? So 1,000 points in 60 days, this is craziness. Okay, why should you hedge? You should hedge because of this period to this period. Now, the problem is you can't just sit on the sidelines, because a lot of people want to say, okay, well, when there's a lot of volatility and when it's scary like this, I'm just going to go sit on the sidelines. I'm going to go into all cash and I'm going to sit and wait until this period is over. Well, there's a problem with that. Over the last 20 years, if you've missed the best days, okay, let's just say you sat those extra couple of days out while you watched it correct, you would have 56% lower returns. Okay, 56% lower. If you miss the best 20 days, and guys, this is a 20-year period. This is missing just 20 days in a 20-year period. That's missing 1 day a year. Okay, you'd be 74% less. So it's not realistic to say you want that 10 or 11% that they always say the market keeps going up and the market keeps going up. But then you go and you sit on the sidelines, because if you do that, you're going to miss the best days. Okay. Because what often happens is, we all know, right, is you get that big pullback, that big correction, and then it skyrockets back up, right? That rip your face off rally that Bubba talks about. You can't just sit on the sidelines. You need to stay invested, but bear in mind, there are bear markets. Okay. Now this isn't intraday. This is annualized, guys. Okay. You see those bear markets as they pull back, but you guys know on the intraday, it's way choppier than this. Okay. So how do you, and this is what I want to know how to do, right? How do I not capture those downs, but continue to grind up? All right. I call that the math of climbing out of a hole. This is the way I was taught it. I was taught it as the math of climbing out of a hole. All right. And by the way, that is Merrill Lynch university. It's actually called Merrill Lynch, MLU, Merrill Lynch University, where I worked for 15 years. Okay. Merrill Lynch teaches this. It's at Princeton, and they actually use the terminology climbing out of a hole. Okay. This is the math of climbing out of a hole. The basic idea of it is losses require disproportionately larger gains in order to recover. Okay. And it's expressed mathematically very simply. Okay. If you have a $25, if you have a $100 price point and you lose $25, okay, you're now at $75 price point, you've lost 25%. But in order to go from $75 back up to $100, you need to gain that same $25 back, except it's a 33% return that you need just to get back to even. Okay, so just so we understand the terminology, losses require disproportionately larger gains to recover. And a lot of you are going, oh, I already know this. I already know this. Bear with me on this, okay? Because this is important to when we get into things later. Okay, so just bear with me. I promise I'll get through this. Okay, so even if you lose 25%, you need to gain 33% just to get back to break even. So yes, of course, in that earlier slide we were looking at, there's those down periods. But if you're able to not participate in the down periods, okay, you don't need that 33% rate of return to get back to even. So how do you limit those losses? This is the idea of hedging. The idea of hedging is saying, I'm not going to go down $25. I'm going to go down $5 or 5%. But if I can capture that $25 ride back up, remember, it goes back up $25 instead of going down 25, right? I only go down 5, but I capture that 25 as it goes back up. I go from having that 100 and being back to break even, going up to 120, right? That's a 20% return rather than getting back to break even. That's a way, that's what hedging is. Okay. It's the idea of avoiding the holes. All right. Now, can you completely avoid the holes? All right. Let you in a little secret. No. Okay. You can't. There's a cost to doing it. All right. There's other factors that are involved. Can you do your best to be as efficient as possible? And that's why I said, even in this example, you still lose the $5. Okay. It isn't that you completely avoid the loss and you just ride up to $25. I would love to do that. That would be completely optimized, but it's not realistic. Okay. There is a cost to it, and the cost is going to be important later. So, what are the best hedging tools that are available? First of all, I think we can all agree that we want to hedge, and that's why we're here today. So let's talk about what the best hedging tools are that are available. Okay. I hear a lot of people talk about things like buying assets not tied to the direction of the market. Okay. Great idea. By the way, very, very, very hard nowadays. Any of you that follow precious metals, any of you that follow real estate, you're going to see that they're so intricately interwoven nowadays. It's very hard to get them to do that. That's not to say that you can't. It's just a little bit more difficult. Okay, so let's look at a couple of those assets that they say are not correlated to the market. So one is real estate, my personal favorite, right? So let's talk about real estate for a second. Let's talk about the actual general market in real estate. You've got stagnant property appreciation and high prices. Okay. So from a math perspective, Wall Street Journal price appreciation slowed to 0.7% with a historical average of 3.4%. What does that mean? It's peaking at the top. It's peaking at the top. The growth has slowed. We've all enjoyed it for the last couple of years. I live now in South Florida. I have watched property prices go in my neighborhood go from $300 to $400 a square foot to $1,800 a square foot. Okay. I've watched that happen over the last 5 years. Okay. It's been awesome. It's been great. Okay. Except there's a problem. Once it hits that $1,800 a square foot price, there just aren't that many buyers. Right. So the appreciation, the price appreciation, it's been going up, and it's kind of stagnated there. Okay. The inventory continues to grow. Guys, 52% of listings right now have been on the market for more than 60 days. Okay. So a national average historically is 32 days. The inventory is growing. People aren't buying. Reduced rental income. We've got high interest rates, economic pressures, high maintenance costs, short-term saturation. Did I mention again those high interest rates? okay, and how that's correlated to the market. We know that. Okay, so as far as hedging is concerned, is real estate a great option? Look, it can be. Okay. There are other plays that you can make with real estate. I'm not going to say totally avoid real estate. If you're interested in learning more about it, learning how to underwrite it, things like that, the Complete Investor, one of the groups we're associated with, can teach you how. Okay. I'll drop a little thing in the chat right now if that is something that you would consider um, learning from. Give me 1 second. I'm gonna drop this right in the chat for you guys. If that is something you guys would like to learn more about and using hedging through real estate, they can show you how to do that. I like it, but I think that there are easier ways to hedge your portfolio. Okay. Another one that people talk about is precious metals, right? Gold, 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 right? Why gold when the markets are like this? Gold and other assets, other metals are considered safe haven assets. Okay. Safe haven asset, meaning that when everything goes to hell in a handbasket, gold keeps on trucking along. Okay. Yes, it does. But remember something, there's also been a pretty big pullback in the last 60 days, right? Now it's recovered from it, but there was a pretty darn big pullback, kind of a scary pullback in gold. There needed to be. It was going all time high after all time high after all time high. We needed a pullback. Okay. That's my personal opinion. All right. Gold is also not just a hedge for the market, guys. It's also a hedge for inflation. It serves a lot of purposes. Okay. After the recent pullback, nearly every indicator has gold prices going up and over to crazy numbers over the next 6, 12, 24 months. Okay. Why central bank and institutional demands are high. The US Iran conflict, fingers crossed, by the way, we never know when the end is in sight, but we may have an end in sight. Who knows? We thought we had an end in sight last week, too. So high inflation with no end in sight for the high inflation, increasing government debt. If you ever get the chance, please go watch one of Gold IQ Group, which is one of the Wealth IQ Group companies. Go watch Gold IQ Group's webinars. Drew is amazing at this. He will talk for an hour about it, and it's so entertaining to listen to. Okay. Forecasts have gold up 6,000 to the $6,300 range. That's Bank of America, Morgan Stanley, JP Morgan. Okay. Precious metals as a way of hedging your portfolio. Guess what? Not a bad idea. If that's something that interests you, I encourage you, reach out to Drew. If you want to schedule him with him, he does do a free information session. Jump on with him and talk about it. I will tell you this, you will not waste your time. It is an awesome session with him. He's extremely intelligent and I love what he does. Okay. However, not everybody wants to go out and buy gold. Okay. And I get that and I understand that. So let's talk about other ways to invest. Okay. That you can make money regardless of market direction. Okay. Now that's one of the keys here, regardless of market direction. Just a quick why in the chat. How many of you here are day traders? How many of you participate in either futures trading, options trading in a day trading format, meaning you get into the trade and you're in cash by the end of the day? Okay. For those of you guys that are doing it, I see one. Don't tell me there's only one of you guys here. Yeah, I know there's a group of you. Okay. So day trading, believe it or not, is considered a great hedge. And one of the reasons why is you make money when the market goes up, you make money when the market goes down. If you know what you're doing, market direction doesn't matter as long as you have the direction for that day, as long as your indicators are getting you in and out of those trades that day. Okay. Do you want to hedge your entire portfolio with your trading? That's a different conversation. Okay. One of the beauties of it, though, you can do this for yourself. This is something that you can learn to do. We teach it at Target. Bubba teaches it. Vici Trading has solutions for this. We all teach different forms of this. You find one that works for you, you can do it. But there's a big flag with this one, guys. Okay. The big flag is it takes time to learn. Okay. It takes time to learn. It takes time to trade. It takes time to manage. And while you're trading, it takes time. Okay. Even if you're only trading the morning session, it's still an hour, 2 hours, 3 hours to be able to do this. So there are alternatives to that. By the way, I mentioned a couple of companies. There are alternatives to that. You don't necessarily have to trade for yourself. Okay. You don't want to, you want the benefits of it. Guys, I've been talking about this for weeks. Full automated trading programs. We just recently rolled out Emergent Edge 15. It actually it's live in the accounts as of today. It's killing it, guys. April numbers on a $10,000 account, it was up $1,297. Great way to hedge. Why? It makes profit regardless of market direction. It's in cash at the end of every night. Okay. Is that a great way to hedge? Absolutely. Is it a direct safety mechanism, an insurance policy on your accounts? Absolutely not. Okay. It is not an insurance policy. It's an alternative. It's an uncorrelated asset. Okay. Uncorrelated assets are hedges, but they're not an insurance policy. You're not protecting the exact investments you made. Okay. What you're doing is you're using alternative ways to generate revenue. Okay. So just to be clear, it's an awesome program. If you're interested, you want to check it out, I'll drop that in the chat for you. Okay. I'm in Emergent Edge 15. I love it. I've been seeing this program. We've been playing with it live for months now. The numbers are crazy. The back testing is crazy. The actual live performance is crazy. It's really cool. Like I said, it's up $1,297 on a $10,000 account in 30 days. It's just a really nice in cash every night type investment, but again, not a direct hedge. So I want to talk about what we came here for, which is the idea of mathematical certainty. Okay. Um, Bubba's got a method that he's been using for years that I really like. Okay. And the 30,000 foot view of it is you're buying puts, you're paying for them with credit spreads, iron condors, right? Um, it's a very unique system, but I want to just explain a little bit before I jump into it. Okay, because not everybody knows options. So I just real quick. Difference between puts and call options, just really quick. I can get into all the details on it, but basically a call option is one thing. You're hoping the price goes up before it expires. Okay, so price has to go up before it expires. That's what you want with a call option. With a put option, you're hoping the price goes down before it expires. So how does Bubba's strategy work? You're buying puts to hedge your existing portfolio. All right. You buy a put option betting that the market is going down. You don't lose when the stock goes down or when the instrument that you're buying the put option on goes down because you're offsetting the loss by having the value of the put option go up. Okay, so the value of the put option goes up and it offsets the loss. You can actually do it to an absolute mathematical certainty. One thing I didn't say from that previous slide is it represents, each option will represent, oh, maybe it's on this one. Each option will represent 100 shares of the stock. So you're saving, you're protecting yourself for 100 shares of the stock with each option that you're purchasing. Okay, there is a problem though. Okay, and it's this word right here. I don't know if you guys can see my, see if I can do that. Oh yeah, look at that. That's cool. It's this word right here. Okay. You can't just put options on your portfolio. You can't just put puts. There you go. That's a bad pun. Okay. You can't just put puts on your portfolio, right? You got to buy them. They have to be paid for. Okay. Why do I say that's a problem? Because by paying for them, you're using money that could be invested that could be going up. So there's a cost to protecting your portfolio. Okay. Well, of course there is, right? Because when you buy insurance for your car, is it free? Is it included in the cost of the car? Absolutely not. You pay for the insurance. When you buy health insurance, there's a cost for the insurance. Okay. So in our minds as Americans, we're used to the idea of a cost. What Bubba does really interesting though is he covers the cost or attempts to cover the cost using credit spreads. Okay. Oh, there you go. Insurance costs money, right? So how do you pay for them? You offset the premiums. The target is to offset the premiums with profits from the vertical credit spreads. Okay. So you're going to take a trade with the intent of that trade covering the cost of the premium, covering the cost of your insurance. The goal is a net zero cost insurance policy. All right. I love the way that sounds conceptually, right? So I have a net zero cost to make sure that I'm protected. Does it always net zero? I can tell you not always net zero. Okay. In fact, sometimes it's positive. Sometimes you actually make money. All right. Sometimes it costs you a little bit of money, but you know what the best part is? You know exactly what you're your absolute total risk is. Okay. Why is that? Because I know what the maximum premium cost is. So if I know what the maximum premium cost is, I know with mathematical certainty what my maximum potential loss could be. Okay. Stop me if that doesn't make sense. Okay. So that's an important concept. If I know what the cost of those options are, and I know what the maximum potential loss in my account is because it's going to be covered by my insurance policy. The cost of those options is my maximum potential loss. Okay, so how many options contracts should you buy? Very simple. Each contract represents 100 shares. You're basically going to do what's called a 1 by 2 put back spread. This is completely designed for downside protection if you're holding long shares. Now, by the way, this doesn't have to be just stock. This can be mutual funds, ETFs. This can be hard asset gold. This can be real estate. This can be all kinds of different things that you can do this as long as there is a corresponding option available in the markets. For those of you guys that don't know this, there's futures options. Okay. There's SEC options or stock options. Okay. There's options for a lot of things nowadays. And by the way, that derivatives market continues to grow every day. So more and more things have option protection. So the structure is very simple. You sell one put option at a specific strike price, often at the money or slightly out of the money, and you buy two put options at a lower strike price. They're cheaper to buy because of the strike price. Okay. So basically, the ratio is for every one contract you sell, you buy two contracts. That's that 1-to-2 ratio. Okay. It's often done for what's called a zero cost or a small net credit. By the way, that net credit, you have to put the money in to do that. Okay. So your max risk at this point is known. Generally speaking, generally speaking, your max risk when you initially do the purchase is 3 to 4%. It can be low, like if you did today's, it was closer to 4%. Last week's, it was around 3% if you were doing it on the SPY. Okay, so generally it's 3 to 4%. Our target goal is about 3% or three. It's about 3.2%. All right. The result is you get a high protection if the price drops drastically because there's two purchase puts that outpace the one that was sold. All right. So the idea is it's a very simple concept, all right, to generate money. The only exposure that you have is if the market, okay, goes east-west. Okay. And that's exactly it, Bill. Bingo, my friend. That's exactly it. You're only exposed to that maximum risk if the price stays flat. Why? Because it doesn't push the option in either direction, and you don't make enough on a growth of the underlying security to cover the cost. But but we're not talking about using this for things that are generally east-west. We're talking about using this for things that are going to go up and down and up and down. We're talking about pulse rates, right? Heart rates, things that are extremely volatile. Okay. So when we've looked at, and I started with these charts, if you guys remember, this VIX is crazy right now. This is why we want protections right now. We want protections right now because we want protections for this kind of a marketplace, not an east-west marketplace. We want protection for that massive pullback. Okay. What does this allow us to do? Okay. This allows us to stay in the market all the time. Okay. This allows us, if you remember that chart, you lose 56%, I believe it is 56% of the upside in the last 20 years if you miss the top 10 days, 74% if you miss the top 20 days in 20 years. Okay. 74% of your upside you miss if you're out of the market. What this allows us to do day in and day out, year in and year out, is to stay in the market regardless of what happens because you know your max risk. So if it does go east-west, your max risk is only that 3 to 4%. And by the way, it's actually smaller than that because the cost of the premiums will go down if the volatility is lower. So they'll get cheaper if the volatility is very, very tight. Okay. So, and this is where Bubba, I have to give Bubba credit for this. This is a brilliant move. Okay. He added a little more to this strategy. And what he did was he added enhanced yields. Okay. And this is where, when you know what you're doing, okay, you can actually get higher returns than simply not having to dig yourself out of the hole. So if you remember that earlier chart that I showed, okay, I'm not going to jump all the way back to it. If you remember that earlier chart that I showed where you had the 5% pullback and then you gained the same 25%, well, that's great, right? Because we were up 20% instead of having a break even. Okay. What Bubba added in was two forms of enhanced yields to this strategy. Okay. The first form are those iron condors I was talking about, those credit spreads. Okay. You can make more than the cost of the premiums. Okay. Historically, if you follow these, listen, I've got students I speak to on a regular basis. They're doing 15, 17% annually on these. Okay. Doesn't sound like a crazy number, but it is if you know that your cost is only 3.2%. That additional amount that you're making on that credit spread gets added to the gains in your portfolio. So if your annualized portfolio was making 20% and you made, say you made 10% on your credit spreads, you only had a 3% cost on your insurance policy, you made an extra 7% that goes on top of your other yields. Okay. So one form of enhanced yield is these iron condors. They can be profitable. Are they always profitable? No, they're not. Okay. And don't believe that they are. Go into this knowing that you have a 3% max risk. Go into it knowing that you're going to pay that 3%. If you're able to get an enhanced yield on top of it, that's great. But if you're not, that's okay too. You know what your max risk is. That's one enhanced yield. The second enhanced yield is pretty cool. Okay. Now, this is very hard to do manually. A lot of this we do when we move. But if the price moves up, and that's what we're going to talk about right now, if the price goes up, okay, you only get the increase in the share price unless you use this strategy. Okay. This is an accumulation of share strategy. And this is where I say that the things that are added with Bubba and the technology, okay, and you can do this, by the way, manually. People do this manually all the time. It just takes a little bit more work. Okay. There is a roll down set. Now, right now it's set at 80 delta. We're actually moving off of deltas. We're moving into percentages. That's a whole different conversation for a different webinar. But when it rolls down, okay, there is a profit on the underlying security. When it rolls down, you're able to capture a small profit rather than leaving the profit in cash. Okay. Rather than leaving the profit in cash, it uses the maximum available to purchase additional shares. Okay. Why is that important? Because when you do get the recovery, okay, and the recovery happens, when you do get the recovery, you're not just recovering with the existing shares you had. You're also recovering with the additional shares that you purchased, the accumulated shares. Okay. So why is that important? Okay. You can add, and some of these yields, guys, have been insane. Why? Because if you had a big pullback and it generated profit and profit and profit, you lowered the basis that you bought in to these shares at to those accumulation points. Okay. When it recovers on those individual shares from those basis points. This is a massive enhanced yield. Okay. This isn't a minor enhanced yield. This can be massive. This can add huge to the bottom line. So what do you get when you do this, say in your IRA or in a retirement account, is you've now accumulated more shares at a lower basis, right? And taken them on the ride back up, right? So two ways of enhancing your yield. You have the iron condors themselves, which are generally speaking, they're profitable. There are periods, don't misunderstand me, where the iron condors aren't profitable. What is your maximum risk? 3.233% is roughly your max risk. Okay. You also can make it through the accumulated shares on those roll downs. All right. Now, Tom, I want to answer your question. If you have something that continues to move up, all right, if you have something that continues to move up, do you lose money on the puts? The answer is yes. You're going to lose your roughly 3% a year. Okay. You are going to lose it, something that continues to move up. This is to make sure that you're protected when it moves down. Okay. It's the same concept as, listen, I pay for my health insurance every month. Health insurance costs have gone through the roof. I still pay for it every month. I pay for long-term care insurance. Am I using long-term care? I'm almost 50 years old. I'm not using long-term care right now. I'm going to use it at some point. I hope I don't need it, but if I need it, it's there. That's what this is designed for. This is designed to be an insurance policy so that when you need it, it's there. Okay. We have a couple of customers. We have one that was in a healthcare. You'll actually see if you go to the website, you'll see their actual full write-up. We copied and pasted their email because it's super, it's incredible. Um, they talked about getting stock options with their company, and they had accumulated a bunch of shares. They had a position. It was a healthcare company. They had accumulated roughly $1 million in shares or $1.5 million in shares. And guess what happened? The company had a big pullback. Now they had just turned the hedging software on in their portfolio. Okay, they had a 50% pullback in their shares. A significant portion of this person's portfolio was in those shares. What did it do? First of all, it capped their potential losses. Okay, capped their potential losses at a very finite part. Then it started accumulating those shares. Well, guess what happened when the share price went back up? They ended up with almost 50% more shares, massive increase in valuation. Okay, massive increase in valuation, and they're able to keep riding that horse. So this is designed, just as I said before, this is designed for those scenarios. This is designed for somebody that doesn't, they're in a situation right now where they can't earn this money back. Okay. They can't earn all of this money back. Their earning power is limited. You're getting close to retirement. Look, I'm not close to retirement. I still don't want to have massive pullbacks in my portfolio. Okay. No, the puts are not the same expiration date. Again, it depends on the size of the account, depends on the settings that you want to do. So that particular conversation is going to depend on you and your size and your portfolio. Now, there's two ways to do that, right? So you can set that up automatically, or you can learn how to do it for yourself. We do, by the way, offer both of those services. But just to be clear, no, you do not always put the same expiration date. You stagger your expiration dates. There's all kinds of things that you can do to spread this out. Okay, and that's really what the idea of it is. And by the way, next week we're going to be doing a very detailed strategy on this. So if you would like to learn more about this in much deeper detail, we'll do it next week. But it's going to be the master's degree version of it. Okay, so I'm doing the high school to college. That'll be the master's degree version of this. It is significant. It is in significant more detail. You got to kind of know what you're talking about to follow it. So that's why I'm going over this one today to see, look, if this is something that catches your attention. Okay, so what is best for you? Okay, so this is something that I talk about a lot when we talk about our different strategies. I have specific holdings, right? I've got some real estate holdings, some metals. I've got some retirement assets, but I don't own a farm. Okay, my brother has a massive 401k. Okay, massive 401k. He's got an IRA, but his only real estate holding is his house. Okay. Um, there are people that have huge amounts of hard asset gold in their IRAs and very small investment portfolios. Every single person is set up differently. Okay. Every single person has different goals. When is your retirement goal, right? What are you trying to accumulate to get there? Where are you in that timeline? Okay. How much more are you going to contribute between now and then? Um, do you have kids? Do you not have kids? Are you married? Are you not married? We all have different financial pictures. Because of that, it's super important to understand that whatever you're doing has to be customized to you. Okay. So when you can't customize something, when you have to buy something that's off the shelf, you have to use it as a tool. All right. And I want you to understand when I talk about the hedging right now, the hedging is a tool. It's a tool that you can use and you can customize it to what you're doing. All right. If what I talked about before about real estate and you go, wow, actually that sounds really interesting, man, grab that real estate tab and look into that. Because if that matches more of what you do than say like hedging software, then follow that path. This is the idea, okay, behind Wealth IQ Group. It's the idea that I'm not telling you that there's a one person, one solution for every person. Okay. This is different solutions for different people. Bits and pieces work for each of us. Okay. One of the reason we talked about this today is I've been talking right now about the hedging strategy. Some of you know what this is. We offer this through Bubba Trading. Okay. Um, this is a completely automated strategy. All right. You customize it to your holdings. So the individual securities that you have, what you want to protect. It's fully automated once it's set up and it runs. It does purchase additional shares for you for enhanced yield. And it has this really cool thing in it called the IRA catch up for synthetics. What it does is it uses options. If you have a smaller IRA, it uses options to create synthetic stocks that have enhanced upside potential, right? And limited downside risk. So it literally controls, with $25,000, you control $100,000 of an equity. So you get massive upside potential with very, very limited risks. I talk about this software for a reason. Guys, I use this software. I have it on two different portfolios. I use the software all the time. Once it's set up, you can turn the dials, you can run it. If it's something that interests you, okay, if you're thinking about it for your 401k, for your IRA, if you're looking at something for um, if you're looking at something for your personal protection, check this out. That is the link to purchase it. Joe, I saw you were in here. Joe, could you drop your appointment, your calendar link in the chat if you don't mind? Guys, Joe Johnson is the student services coordinator for Bubba Trading and for Target. He is absolutely fantastic. He knows this business. He knows all about hedging, and he can talk to you in greater detail about whether or not it's applicable for you and it works for you. I strongly encourage you to take your time and jump in and have that conversation with him. Uh, I would not, okay? I would not sit with my IRA in mutual funds right now, or ETFs or whatever you have it in, with the amount of private credit risk that's out there right now. Any of you guys that are following that, Blackstone's having huge problems with it. Owl Fund is having huge problems with it. Private credit funds they're going upside down. I can get into the details of why that's happening, but I can tell you they're going to zero. Okay. Um, No, there is not a setup fee any longer. We actually did away with the setup fee. There's an annual fee and there's a monthly fee. That link only takes you to the annual fee. There is a coupon code there, by the way, I threw in that saves you $500 on the annual. It ends up costing you guys. It'll cost you less than $200 a month. If $200 a month is worth it to you to save your portfolio, I strongly recommend getting it. Um, I don't think we're in a good situation right now. This is me looking at this from 25 years in the financial markets. This is me in conversations with Bubba, with Ryan, with Pat. Guys, I don't think we're in a good situation right now. I think the pullback that we had a month ago is just the tip of the iceberg. There is just too much government debt out there right now. There's too much at risk right now. We've been cranking these all-time highs for years and years and years and years. We got something big coming. I would urge you to protect yourself. If you're not comfortable setting up the trades yourself, I would urge you to do it with full automation. Okay. Do you have to do it with full automation? You don't have to. If you're an options trader and you'd like to try it for yourself, go for it. The discount's $500 off. It's one day. It's one day is the coupon code. It's right there in the chat. It's one day. The word one, the word day, 500 saves you guys 500 if you put it in on the acquisition. If you do purchase it, all right, we will get you guys set up. We will, if you're not an existing student, you get access to John Dollarhide, who's one of our instructors, to help you get it configured. We also have an awesome library that you can go through to see all the instructional videos. Guys, this isn't stereo instructions. This is a really easy program to use. Once you set it up and you configure it, you can learn how to turn the dials. And of course, our entire support team is always available. And you get access to Bubba. Gotta say, getting access to Bubba is a huge thing. If you're in his chat, if you're in any of those groups, you guys know. And Joe just dropped in a schedule link. If you'd like to learn more about this, if you'd like to see it in action, if you'd like to ask questions, etc., schedule some time with Joe. I will say this: if you schedule it, please show up. Joe is super busy right now with all of the companies. Just if you see time on his calendar and you schedule it, please show up. Please be prepared. He will give you the time. Okay, Joe and I have been working together for 6 years. He's amazing. All right, so take advantage of the time that you have with him. I did drop some earlier links. If anything with the real estate or gold interested you, sign up and schedule on those. Cannot tell you enough how proud I am of being able to roll out what we're rolling out right now. Okay. The Wealth IQ group is really something special. This is an idea that I had. This is not a joke. I had this idea back in 2019, and it's taken me this long to get the right players involved. Those of you guys that have participated with Bubba, a lot of longtime Bubba customers in here, those of you guys that have been a part of the target trading world, those of you who've been a part of Gold IQ group, those of you who've been a part of the Real Deal Network, and all of our different groups that are here, okay, cannot tell you how awesome it is to finally be able to put all these pieces together. We are here to help you, okay? We are here to help you grow your wealth, and we are here to help you protect your wealth, all right? I am accumulating the best and the brightest in the industry, and I'm bringing them to you guys. So stay tuned. Every Wednesday, you guys are going to see Wealth IQ Group webinars. Everyone's going to be different. We're going to have ones on litigation proofing yourself, on tax strategies for investors. We've got one coming up on real estate, which is going to be very interesting. It'll be the first one on real estate that we've ever done. I'm super excited about this one. This is my bread and butter, so I'm very, very excited about this one. So here's what I can encourage you guys. Key takeaways from today. All right, you got to stay invested. You got to hedge your downside risk. Learn option strategies. If you don't want to learn them, you just want to go right into the automation. Use the automation. Use it right away. The purchase link is right there. If you have any questions, drop them in the chat. And thank you guys so much for paying attention today.